Inflation is not a new phenomenon. It has been a silent force shaping economies since the creation of the Federal Reserve in 1913. While it might seem manageable on a year-to-year basis, its cumulative impact is staggering. Inflation erodes purchasing power, meaning the money you have today buys less tomorrow. This silent tax affects every household, often without immediate recognition. The historical record shows us that inflation is rarely, if ever, transitory. The speaker rightly points out that since 1913, the purchasing power of the US dollar has declined dramatically. What could buy a family a month's worth of groceries now barely covers a single meal. Inflation is not an accident of the system. It is baked into the very nature of fiat currency. The constant expansion of the money supply, whether through quantitative easing or deficit spending, ensures that every dollar becomes progressively weaker over time. The year 1971 was a watershed moment in financial history. Under President Nixon, the United States formally abandoned the gold standard, severing the link between the dollar and gold. Before this, each dollar had a tangible value tied to a physical asset. With this change, the dollar became a fiat currency backed only by the full faith and credit of the US government. For the average person, the shift might have seemed abstract at the time. However, its implications were profound. By decoupling currency from gold, central banks gained unprecedented control over monetary policy. They could print money at will, ostensibly to stimulate the economy or respond to crises. While this increased flexibility for governments, it introduced perpetual inflation, which continues to chip away at savings and earnings. This move marked the beginning of an era where trust in currency is rooted not in its intrinsic value, but in the stability of the institutions behind it, a trust that has often been tested during economic downturns. In the 1980s, globalization was heralded as the key to economic growth and prosperity. Supply chains stretched across continents and goods became cheaper and more accessible. But as the speaker highlights, this shift came at a significant cost to the average worker. Manufacturing jobs were outsourced to countries with cheaper labor, leading to a hollowing out of the middle class in developed nations. The promise of globalization, lower prices, and greater efficiency masked the reality of wage stagnation and job insecurity for millions. The fragility of these global supply chains became starkly apparent during the COVID-19 pandemic. Disruptions in one part of the world had ripple effects across industries, exposing the vulnerabilities of an interconnected system. What once seemed like progress now appears as a precarious arrangement, leaving workers and consumers to bear the brunt of its failures. Inflation does not affect everyone equally. While it erodes the purchasing power of ordinary citizens, those who hold assets, real estate, stocks, and businesses often see their wealth increase. This disparity is at the heart of growing income and wealth inequality. The system as it exists seems designed to favor those at the top. By keeping interest rates low and flooding markets with liquidity, central banks have inflated asset prices, benefiting the wealthy disproportionately. Meanwhile, wages for the average worker have struggled to keep pace with the rising cost of living. The speaker points out that in the 1970s, a single wage earner could support a family of 4. Today, even dual-income households struggle to make ends meet. This widening gap is not an accident. It is a consequence of policies that prioritize market stability and corporate profitability over equitable economic growth. Financial markets are often portrayed as the backbone of modern economies. Yet, as the speaker warns, they are increasingly fragile. The bond market, for example, is rife with hidden risks. Low interest rates have driven investors into riskier assets, creating bubbles that could burst with devastating consequences. Institutional investors who manage the savings and pensions of millions are particularly vulnerable. They are often the last to react to market shifts, left holding the bag when bubbles burst. Meanwhile, those with insider knowledge, large financial institutions, and the ultra-wealthy move their wealth into safer assets like gold and real estate. This fragility is not just a technical issue, it reflects deeper systemic imbalances. Markets that rely on ever-increasing debt and leverage are inherently unstable, and the fallout from their collapse often falls hardest on those least equipped to bear it. In a world of depreciating currencies and volatile markets, hard assets like gold and real estate offer a measure of stability. Gold, in particular, has stood the test of time as a store of value. Unlike fiat currency, which can be printed endlessly, gold is finite. Its value is intrinsic, rooted in its scarcity and historical role as money. The speaker highlights a simple yet powerful calculation. If an ounce of gold is worth $50,000 based on its fundamental value, then any price below that represents a bargain. This perspective underscores the importance of viewing gold not as a speculative investment, but as a hedge against currency devaluation. Real estate, too, offers a tangible store of value. While it is not immune to market fluctuations, property has historically appreciated over time, providing both utility and investment returns. Cryptocurrencies like Bitcoin have gained popularity as an alternative to traditional financial systems. Their appeal lies in their decentralization and resistance to government control. However, as the speaker points out, they are not truly private. Opening a cryptocurrency account often requires personal information, and transactions are recorded on a public ledger. While this system offers transparency, it also means that users are not as anonymous as they might think. Moreover, cryptocurrencies are dependent on digital infrastructure. Unlike physical gold or cash, they cannot function without electricity and internet connectivity, making them less practical in certain scenarios. The move from physical gold and silver to paper money and eventually to digital currency has been framed as a matter of convenience. Paper money is lighter and easier to carry. Digital transactions are faster and more efficient. However, this transition has also eroded public control over monetary policy. When money was backed by gold, individuals had the option to convert their currency into a tangible asset. This acted as a check on government spending, as excessive printing would deplete gold reserves. The shift to fiat money removed this restraint, allowing governments to inflate the money supply without immediate consequences. The rise of digital payments has further centralized control. While cash transactions offer a degree of privacy, digital payments are fully traceable. This shift raises concerns about surveillance and the potential for abuse by authorities. While physical cash still offers some privacy, it fails to protect purchasing power. Inflation ensures that a dollar today is worth less tomorrow, eroding savings held in cash. Gold, by contrast, has maintained its value over centuries, making it a reliable store of wealth. The speaker underscores the importance of understanding these dynamics. By holding assets that preserve purchasing power and offer privacy, individuals can safeguard their financial future against the uncertainties of an inflationary system. In conclusion, the financial landscape has undergone profound changes over the past century, from the abandonment of the gold standard to the rise of digital currency. These shifts have concentrated power in the hands of governments and central banks, while exposing ordinary citizens to greater financial risks. To navigate these challenges, it is essential to learn from history and adopt strategies that prioritize stability and resilience. Whether through hard assets, careful investment, or a deeper understanding of economic systems, individuals can take steps to protect their wealth and ensure greater financial security in an uncertain world.